My next guest believes this earnings season will come down to the haves and the have-nots. Joining me here at Post 9 to explain is Alger's Ankur Crawford. Welcome back.
Nice to be here.
Who are the haves? The obvious ones? The mega cap tech names?
Well, not all mega cap tech. So I would say last time we were on, we talked about a Mag 4.
Okay.
I think we're still there. We have this Mag 4 and a bifurcation in our Magnificent 7. Google has caught up a little bit, but we still think that, you know, the existential risk to search is something that's not going away. So as
you're less bullish that name relative to the others?
Relative to Microsoft, NVIDIA, Meta, and...
Well, because earlier, you know, we were having this conversation about this new announcement from Meta today and this partnership with Alphabet, and I read that stat. You go back over the last 12 months, say, well, Alphabet's up 50%, Microsoft's up 40%. So maybe the narrative that developed was exaggerated and people were writing that company and that stock off too soon. Maybe.
That could be, but they have to. Look, I believe that Google can produce some sort of AI capability that is astounding. But so can a lot of other people. They're going from a market where they were effectively an oligopoly, perhaps, in the digital advertising market, to a market that is much more fragmented. And I just have a rule of thumb: I won't buy market share losers. In part because when you start losing market share, there's a lot of negative things that start happening to the business model.
Even when your market share is so incredibly elevated that losing a couple points of market share is not necessarily going to make a huge difference?
Well, I think once you start losing market share, you don't lose just a couple points of market share. And an example is I use Perplexity AI every single day. It has changed the way I search. And this is just the beginning of the changing way we're going to search on a go-forward basis. So Perplexity has nothing to do with Google. And the more people I tell about Perplexity that use it, the more love using it and come off of Google. So I just think it's complicated.
Okay. Do you feel like because of the increased volatility now and the backup in rates, that now these tech earnings, which start next week, have that elevated importance that we've been debating for seemingly forever?
Oh, for sure. But I do think it's a bit of a blessing for the market and for the stocks that they have come in as they have into earnings. And in part because, like we were just talking about TSM. You know, TSM had run into earnings, very strong expectations. They come in, you know, the numbers don't change that much. You know, find a little bit of margin because of power. They gave up and a little bit of squishiness on the industrial side, but the story is really about how they're ramping in AI, and they are the vendor that will provide everyone a chip. It trades at a 25% discount to the market. If it's down 4%, that's okay, because it's at a relative discount that is unwarranted.
So let's talk about the market at large. We're down, so you'd say 4% for TSM. The S&P's about 4% or so off of its high. I hope you heard the conversation we just had with Rick Reeder, who said the equity market's going higher, and now I'm paraphrasing, that was a direct quote, that the market's making too much of this back up in rates, and it's still going higher because equities can move up even if rates remain at this level.
Yeah.
You agree?
I think, again, it's going to be a bit of a bifurcation. So higher rates have implications for the economy. Economically sensitive stocks, we saw this broadening of the market over the last month and a half, where everyone, like small caps and everything, started to rally.
Before the backup in rates, obviously.
Before the backup in rates back up, it means choppier waters. It means you go back to the secular growth. And so I think that's what's going to start to happen as rates go up, and until we see what happens in the economy and the impact it will have in the economy, you get a narrowing of the market, led again by kind of secular growth, which is today it's AI. I mean, where it will affect is biotechs. You know, groups like biotechs, which are long duration assets that don't have that, you know, implicit secular growth that's here and now, they probably suffer more than tech.
So we're back to where we were.
We're back to where we were.
You're not a believer today in the broadening trade so much as a result of what's happened with rates, and especially if rates stay where they are, or even as some firms are suggesting, you know, 10-year goes to 5%. And as Rick said, I mean, that could happen at any time now. It's not like we're that far.
No, I think the 10-year could go to 5%. I actually think it's really bullish, to be completely frank, that the economy is as resilient as it is, when the Fed has normalized a 2-decade-long hiatus on ridiculous rates, and our economy is still resilient, and the consumer is still showing this resilience. I think it's quite bullish for our economy, because now we have a lever. When we do need it, the Fed can react. I personally thought that if they did cut, the market would go down anytime this spring. So I'm actually quite pleased that they're not going to cut.
All right, we'll make that the last word. Enjoy our conversation as always.